Hello folks, Charlie Gipple here with CG Financial Group. So last week I was thinking, how can I make a video on a topic that is like the sexiest topic on earth? This topic needs to be so darn exciting that everybody that listens to this is going to watch and rewatch this video time and time again. They're going to want to do a ton of business with CG Financial Group. And I thought, that topic, I know what it is. And it's going to be paid up additions riders on whole life insurance. That's it. So that's what we're going to talk about today. And of course, I'm being facetious here, but I will say that the paid up additions riders, if one could take that concept, which is probably the most misunderstood concept on whole life insurance, take that concept and explain it in a way that people understand, well, that's pretty darn good, right? And that's what we're going to do today. That's what we pride ourselves on at CG Financial Group. If you saw our tagline on our logo, it is simplifying financial security. We take the complicated, we simplify, and that's what we're going to do today. Because you know what? This stuff does not have to be so dang complicated to our customers. You are my customer, and therefore the brain damage that I go through, this stuff is complicated, right? It's complicated for me to understand because it's complicated stuff. But I try to be courteous enough that I spend just as much time trying to distill down the message that I now understand so I can communicate it to you in a way that you don't have to go through the same brain damage that I did. And hopefully that is what we do here with paid up additions riders. Now, before I get started, I will say this. We've done webinars here recently on whole life insurance versus indexed universal life insurance. Technically, it's the other way around. IUL versus whole life insurance is what the title of these webinars have been. Had a few hundred people on the webinar a couple weeks ago. We're going to do another webinar here soon. So send me an email if you want that link to register for IUL versus whole life insurance. Now, even though I say versus whole life insurance, I don't technically mean one is better than the other. Now, for each client's situation, there is probably one product that's better than the other, and that's really what the webinar is about. Now, in that vein, I like to say this. You have two different pies, and the ingredients to make those two different pies, whether it's IUL or whole life insurance, the ingredients are the exact same, right? And what are those ingredients? First of all, you have an insurance company. And those insurance companies today, on average, have a general account yield of 4.5%. Let's just say 4.2 to 5.5%. All the insurance carriers, for the most part, are dealing with. When those insurance carriers take the client's money, that's where that money is going, into that general account, and that's yielding a certain percentage. Today, the average is around 4.5%. And again, whether it's IUL or whole life, that's the same. Just because an IUL is linked to an external index, it doesn't mean it's not invested in the company's general account. It is, in fact, invested in the company's general account. It's just that there's a small chunk of that buy and call options. So the same ingredients there. In addition to that, each of these carriers have shareholders. Those shareholders want a certain amount of return on their equity investment, right? Maybe it's 8%, maybe it's 10%, maybe it's 12%. By the way, don't get me started on the decreasing interest rates over the last 35 years, but yet insurance carriers, they still want their shareholders to get 12% or 13% or 14% or whatever. I won't go down that road here. That's a completely different topic. So you have that. That's the same whether it's IUL or whole life insurance. In addition to that, these governors on these policies, which are TEFRA, DEFRA, and TAMRA. You cannot cram $1 million into a whole life policy if it has only $1 million death benefit, right? The same thing with IUL. So the same governors exist on the cash value, whether it's whole life or indexed universal life insurance. You have basically the same agents, so the same distribution costs built into these policies. You have the mortality that's the same built into these policies. It's just a matter of creating the pie in a different way because you're dealing with the same ingredients. So when I say that whole life insurance versus IUL, when I talk about that concept, it's not like one is better than the other. It's just a different way of skinning the cat. Like paid up additions riders are kind of a different way of skinning the IUL increasing death benefit cat. So I hope that makes sense. Now, let's get into the good stuff here. What is the definition of whole life insurance? What's the definition of whole life insurance? You know, I have kind of two parts to the definition of whole life insurance. This isn't technically correct, but this is Charlie's definition of whole life insurance. I'll bet it's pretty dang close. I don't know. I haven't looked it up. But first of all, whole life insurance, what it does is it guarantees life insurance coverage for the whole life of the client. Well, what's the whole life of the client? Once upon a time, with the older policies, it was like age 100, right? Today, with expanded mortality tables and extended life expectancies, today most whole life policies go out to age 120. Now, at age 120, to get to the second part of my definition of whole life insurance, what happens at age 120? This second part to the whole life insurance definition to me is the most important because it's the most actuarially significant that determines a lot of other things in the policy. And let me explain here. Well, at age 120, what a whole life policy does is it guarantees that the cash value equals the death benefit at age 120 or whatever the maturity date is. Now, why is that so actuarially significant? Because if the company is guaranteeing this, if they're guaranteeing the cash value to look like that, then that creates some other provisions in the policy. That creates a lot of other provisions in the policy, right? Such as you, the client, are bound by certain premium levels, a certain premium schedule based off of this particular product that we are offering. Maybe the product is a pay to age 90 where the client pays that amount of premium. Maybe the product is a pay to age 65 where the client puts in a little more premium but pays it in a more accelerated fashion. That is all specific to the product, but the insurance carrier with whole life insurance is a little more rigid when it comes to the requirements. Why is that? It's not that whole life insurance is bad. Well, the reason the insurance company is more rigid is because the guarantee that the insurance company is giving the client is very rigid, right? And that is, okay, for the next 100 years, we will guarantee you a cash value of that, a death benefit of that. Well, yeah, the client is mandated to pay that premium. And of course, the dividends are on top of everything that we're talking about here. Now, let's get to this thing here. Let's get to the premium schedule. So just because a whole life policy goes out to age 120, that does not mean that that's what the client is required to pay in premium. And again, this is specific to the product. Based off of the guaranteed rate embedded in the contract from a cash value standpoint, based off of the guaranteed max cost of insurance charges that the company has embedded into that cash value calculation, all of that stuff, and then based off of how many years of premium is going to be paid, which, let's take this product here. Let's say this is a pay to age 90. Well, based off of all of those factors, the insurance carrier is going to say, okay, you're mandated to pay until age 90 a certain level of premium, and you are mandated. This is not a flexible premium contract like universal life insurance is, right? You'd have to pay a little more if the product was a paid age 65, for example. Now, let's talk about paid age 90 versus paid age 65 versus a, say, 10-pay whole life policy, or another one that I'm looking for here. I'll ask a question here. Of course, it's a rhetorical question because this is a one-way video here. The question is, all else being equal, what is the best way to cram as much cash value into a policy? What's the best, fastest way to cram as much cash value into a policy? All else being equal, is it the long pays, like paid age 90 or paid age 100 or paid age 120? Or is it like a 10-pay? Or is it a single premium structure? The best out of all of these, not taking into consideration the tax code or anything, is a single premium structure, right? You pay just one giant premium, and if this whole life policy was in fact a single premium whole life policy, maybe the cash value would look something like this, right? Start out much higher and then again endow at age 120, if this was such a policy. That is the most effective way to fund a life insurance policy, at least when it comes to cash value, which is what many of these policies are designed for, right? Here you have the pay to age 90 cash value down below. Well, here you have the single premium. But why don't carriers develop more single premium whole life products, and why don't clients buy a ton of single premium whole life products if that's the most effective way to cram as much cash value in the policy? Because of these things called TEFRA, DEFRA, TAMRA, right? If you pay any faster than a 7-pay, what do you have? You have a modified endowment contract. So, okay, that's great, Charlie. So you're saying there are products out there that mandate that the policies be paid in a certain way, whether it's to age 90 or paid to age 65 or a 10-pay or what have you. So then how is it that we're able to take this inherently inefficient product, I guess you would say, a pay to age 90, and make it more efficient from a cash value standpoint? How is it that we are able to do that? Paid up additions riders. That's how we're able to do that. So let's take away everything except for the pay to age 90 and the single premium. So here you have the single premium, there's the pay to age 90. That single premium life policy example here, what is a paid up additions rider? What a paid up additions rider is it is a miniature single premium whole life policy. That's what it is. So what if you could take your premium, your $1,000 a month that you're paying, and say, you know, yes, the base policy, we have to have a base policy, right? Because that's what we're buying. But what if we blend in with a portion of our premium? What if we blend in with a portion of that premium, say some of the single premium life component? What if we blend in the right percentage to where basically the cash value treatment ends up being treatment similar to, well, somewhere between as if you paid at age 90 and if you dumped in a single premium product? And what if it was tuned in so much that it was right below, that our funding level was right below the modified endowment contract level? That is exactly what a paid up additions rider does. So for instance, of that $1,000 that I am paying per month in a whole life policy, I may say, you know what? For a 45-year-old, usually the optimal percentage is, you know, to blend these two out so it's not a modified endowment contract, but yet being funded efficiently. For a 45-year-old, many times it's like 60%. Okay, so 60% of my $1,000 a month, or $600, is going to go to a paid up additions rider. And again, what is that paid up additions rider sliver? That is a miniature single premium whole life policy, right? But then the other $400, what that's going to do is that's going to fund the base policy. And what you have there is a mix of paid age 90, single premium life, a mix that, well, is right at the modified endowment contract level. How do I know what that mix is? In most of these illustration systems, it will give you an optimal mix if you want the max accumulation. If you click on the max accumulation solve, so to speak, in that policy. Now, let me demonstrate visually what a paid up additions rider is. So you have premiums going in, again, to age 90 because that's what's mandated, right? And I won't get into reduce paid up and pay from policy values. That'll be in another part of this whole life series here. But let's look at a visual example of what paid up additions are. So here you have the death benefit. That's the death benefit. The death benefit on a policy, a paid age 90 policy. And then based off of the premium that you're putting in, the cash value on that paid age 90 is that. So let's say that, again, with $400, we got that death benefit. $400 a premium, we got that death benefit. But then that additional $600, to use my previous example, we're going to buy a paid up additions on that first year's premium. What happens there? What happens is you have an additional sliver of permanent coverage. And by the way, that paid up additions rider, that paid up additional policy, that has cash value of its own, right? And that cash value is going to equal, at age 120 or what have you, that's going to equal what the death benefit is, right? And then in year 2, when you pay that premium and have a similar split, you have an additional sliver of a single premium whole life product. Year 3, you have an additional sliver of that whole life insurance product, a single premium whole life product. But what happens is when you blend out the impact of of what the cash value does with these single premium life contracts, when that's added to the pay to age 90, you have a trajectory of the cash value that is much steeper than if you just stuck with that base policy and put $1,000 per month into that base policy. So what you're doing is you're effectively blending in, and you're taking a rigid premium structure, which is pay to age 90, you got to pay it to age 90, and you're blending in single premium life insurance policies to hit that modified endowment contract level, actually just shy of that modified endowment contract level, in order to do what? Well, instead of having a trajectory like that, what you're able to do is the overall policy may have a trajectory more like that, that's steeper, right? Thus the cash value, thus the tax-free retirement distributions that that client can ultimately take. Hope that makes sense. A little more technical, but if you didn't understand paid up additions riders before, I hope you understand it better now. Have a good day. Charlie Gipple here. Give us a call, 515-986-3065.